Japan's government, last March 2024, announced provisional figures showing that the economy had unexpectedly slipped into recession amid sluggish domestic demand and private consumption. While the revised figures mean that Japan escaped recession, defined as 2 consecutive quarters of negative growth, the improved figures are likely to boost expectations that the Bank of Japan may end its unconventional policy of negative interest rates, introduced nearly a decade ago. The economy of Japan has struggled with meager growth throughout several lost decades following the collapse of a massive asset bubble in the early 1990s. Despite the Japanese economy's struggles, Tokyo's stock market is riding high as foreign investors take advantage of the cheap yen and corporate governance reforms that have boosted returns for shareholders. The benchmark Nikkei 225 index earlier this month smashed the 40,000 mark for the first time after surpassing its 1989 peak in February. Japan's economy expanded by a faster-than-expected annualized 3.1% in April through June, rebounding from the previous quarter thanks to a strong pickup in consumption and backing the case for another near-term interest rate hike. The Bank of Japan had forecast that a solid economic recovery would help inflation sustainably hit its 2% target and justify raising interest rates further. Avoiding recession. Japan's economy has narrowly avoided recession, underscoring the economic challenges facing the East Asian giant even as its stock market is cruising at its highest levels in decades. The revised figure for gross domestic product, GDP, released by Japan's Cabinet Office, compared with economists' median forecast for a 1.1% uptick in a Reuters poll. The fresh data meant the economy of Japan, now the world's fourth largest behind Germany, avoided a technical recession thanks to companies' stronger-than-expected spending on plants and equipment. On a quarter-on-quarter basis, GDP grew 0.1%, compared with the initial 0.1% drop reading and a median forecast for a 0.3% rise. Capital expenditure increased 2% quarter-on-quarter, better than the preliminary 0.1% decrease the government announced, but below a median market forecast of a 2.5% rise. The upward revision came amid growing market expectations that were fueled in part by board members' recent hawkish comments that Japan was moving towards the central bank's 2% inflation target. Meanwhile, private consumption, which makes up about 60% of Japan's economy, fell 0.3% from October to December, slightly worse than the 0.2% drop in the initial estimate. Japan last March saw inflation-adjusted real wages in January shrinking for the 22nd month in a row, while year-on-year household spending in the same month marked the biggest drop in 35 months. External demand contributed 0.2 percentage points to real GDP, unchanged from the preliminary reading. Consumers poised for a rebound. Most indicators of consumer spending remain weak, but there is evidence of a turnaround. Real household spending in May was down 1.8% from a year earlier, but this is a considerable improvement from the 6.3% year-over-year decline in January. In May, retail sales growth accelerated, but other measures of consumer spending, such as the Real Consumer Activity Index, have yet to show signs of acceleration. Nevertheless, consumer fundamentals have changed for the better, which should usher in stronger consumer spending in the coming months. Part of the improvement comes from the labor market. In establishments with 5 or more employees, scheduled earnings, a measure of wages that excludes overtime and bonuses, rose 4.7% from a year earlier in May, the fastest pace of wage growth since 1992. And with wage growth outpacing inflation, which stood at just 2.8% in May compared to a year earlier, households have greater purchasing power. Meanwhile, unemployment has remained very low, at 2.6% in May, and total employment continues to grow. Meanwhile, rising food and energy prices pose one challenge to consumers. Fuel, light, and water charges were up 6.6% from a year ago in May, reversing a trend of annual declines since February 2023. Food prices were up 4.1% from a year ago and grew at an annualized 5.3% over the prior 3 months. The recent rebound in these prices has likely weighed on consumer sentiment and discretionary spending. The Consumer Confidence Index fell 3.3 points over the prior 2 months, and real household spending on culture and recreation declined 9.6% from a year ago. Exports tangle. Foreign demand is not limited to tourist services either. Goods exports have accelerated and were up 11.9% from a year earlier in May. A weak yen is part of the reason exports are growing so quickly, but so is the global technology competition. Tellingly, integrated circuits exports were up 32.2% from a year ago in May. Transportation equipment and chemicals also grew at double-digit rates. Such strong demand for Japanese goods and services can also increase inflation as capacity constraints are tested. Although an inflation rebound is yet to materialize, the signs of it remain too strong for the Bank of Japan to ignore. Wage growth, in particular, is signaling that inflation will potentially move higher, and that consumer spending will likely pick up soon. As the Bank of Japan begins to tighten, the yen should stabilize or even appreciate, which will reduce the cost of food and energy, giving consumers an additional boost to their spending power. While a stronger yen may ultimately hurt Japanese goods and services exports, the yen is expected to remain weak by historical standards, which should allow ample foreign demand to persist. Capital spending, a key driver of private demand-led growth, rose 0.9% in the second quarter, versus an increase of 0.9% seen by economists in a Reuters poll. The Bank of Japan raised interest rates last month and detailed a plan to taper its huge bond buying in another step toward phasing out its massive monetary stimulus. So, what do you think? Even though Japan escaped a recession on the brink, can it maintain it? How did we do? If we missed something, please say in the comments. And if you like this video, please give a thumbs up and subscribe to our channel.